Welcome to another edition of TokStocks. I'm your host, Keir Reynolds, and today we're lucky enough to have Sean Black, Chief Investment Officer of Happy Belly Food Group. Trades on the CSE with the ticker HBFG. Hey, Sean, how you doing today?
Good. Thank you very much. Thanks for having me on. It's been a while.
Yeah, I guess we talked about 3 months ago, so sort of due for our kind of quarterly update. You guys haven't been quiet. You guys have been very busy. I was looking, 3 pages worth of news releases, I think, since we last chatted. Very impressive, very busy. So maybe for those of my viewers that don't know who you are, would you mind just giving a little bit of a background on what you've been up to, who you are, and all that?
Sure, absolutely. We are a multi-branded emerging brand consolidator, really is what we are. Across Canada today, we have total 9 brands, 2 of them in the CPG side, 7 in the QSR and restaurant side. And we literally consolidate the brands and accelerate growth. We look for what we label as an emerging brand and bring it into our portfolio and grow it. So we're traded today, as you mentioned, HBFG on the CSE. We're one of the up and coming company consolidators in Canada, trying to be like some of the big boys that are out there.
And you mentioned like the big boys. What would be some of the big companies that you sort of are modeling yourself sort of after?
Well, one in particular in the food space that we really like to model ourselves after is MTY. Consolidator out of Montreal. Today they're about 90 brands. I think they do, approximately 1.5 billion a quarter in system sales. That was a company I previously worked for. Spent some time there. That's one of them. I think the other 2 that are great models to follow. One would be Boyd Auto Group, BYD.to, and Constellation, CSU.to. I think those are for someone that's an up and coming company or somebody that's an entrepreneur that's growing and trying to do like what some of the really good ones have done. I think Boyd, Constellation, and MTY would be the leaders and who we aspire to be when we grow up.
So you and your team, it's kind of like putting the band back together again. You've done some things already sort of in the QSR sort of food space and full service as well. I guess you guys were early, a long time ago behind the founding of Mucho Burrito, which became a franchising success here in North America. And then also, I guess more recently, we're able to build and monetize and sell the Burgers Priest brand. So could you just sort of explain a bit about what you guys have been up to as sort of a team, what you've worked on before?
Absolutely. Yeah, we're very fortunate. Started around 2000. We got into, I'd been in the business since I was a kid. Started working when I was 14. Opened my first one at 19. As I was looking for new opportunities, I met 2 partners, Alex and Mark Kiki. Partnered up with them on a franchise model. First, I started as a franchisee and brought Extreme Pita, a brand, to Ottawa. Once we got that brand going, I joined as a partner. We scaled that brand to about 100 stores at the time, and we came up with an idea to be the leader of fast casual Mexican in Canada. We launched Mucho Burrito. We grew those 2 entities to over 300 stores. With Pipeline, we were close to 400. We sold them to MTY. That was our first exit in the business. As part of that deal, I joined MTY as their chief development officer. Really learned the ropes on the public side, and that's where it early on gave me the bug that maybe, hey, someday maybe I'll do this. But it didn't really come full circle until after. Once I was done my time at MTY, we partnered up again, Alex, Mark, and I. We launched Crave Restaurant Group. We grew 2 brands that a lot of people know in Canada, Burgers Priest and Fresh. We grew those to become very successful category leaders. We exited with a sale of those to Recipe and Fairfax in summer of 21, Q2 21. And that made us free agents and brought us full circle to a small company that at the time was called Plant & Co. pretty niche market business. Since then, we launched Happy Belly, became a little more agnostic to the food business, and I believe we have become the leading consolidator of emerging brands in Canada.
Excellent. Thanks for the overview there. Since we last spoke in March, could you mention today how many how many corporate stores you have operational?
Yeah, all the corporate stores we have today, there's 5 of them on the sorry, I'm coming out of brain cramp here. 5 of them on the health and wellness side. We operate those stores. We've now entered into the franchise model on that side, and we have more of that brand coming. I think I looked the other day. Previously, when we talked, we were in the single-digit stores, probably when we were operational when we first talked, and today we're 29 restaurants open across Canada. Currently, we have 14 at different stages of construction, and a lot more on the way. And I think if you look, I think when we first started talking, our goal was to do 15 to 25 open this year. We've already opened 3. We have 14 in construction. So I think for most people that do the math, they're going to see, I think we're going to achieve our goals for 2024.
Oh, that's excellent. So in total, between sort of franchised and corporate, you have 29 stores
operational today. And at minimum, another 14 that are scheduled to open this year. So that'll get us into the 40s, and we have our foot firmly on the gas. And we're only in June.
What brands are you most focused on out of your portfolio?
Today, the by unit count, the growth is coming from health and wellness, our smoothie bowl concept, followed by now you're going to start to see the accelerated growth of Rosie's, our burger brand, our smash burger brand out of Ontario, and Yolks, which is a brand out of BC. We are actively in construction on the current stores. We're actively in lease negotiations and working with franchisees across the country to accelerate the growth of those. Joey Turks is under construction. It's seeing some growth. And finally, we've got Pyro ready now. Pyro's expanding into Alberta, which is our answer to CAVA. If you look at the market today, CAVA's been recently up to $11 billion market valuation. They're the category leader with 350 stores. We have 3, and we're going to carve out our own market here in Canada, just like we did with Mucho Burrito as an early mover advantage. Very transparent. We're trying to mark our territory here in Canada before anybody else comes in.
Right, and so part of that is you've gone out and done area development deals with people that are experienced with building and growing sort of franchise brands. So out of those sort of area development sort of agreements and franchise sort of stores, what's the total number of locations that you're now financially committed, that you've got financial commitments for?
Through our area developers today. One thing that's important for people to realize, the minimum number of stores we have committed, it's not a maximum, it's a minimum number of commitment. It's 326 stores across Canada. And we're obviously just in the process of entering the United States as well in Florida. But the minimum number of commitments we have is 326, and we are actively trying to accelerate that number with our current brand portfolio, as well as potential other brands that come in on the inorganic side. But that doesn't include corporate development in Ontario. So before the end of the year, we will look to accelerate that 326 to a higher number. Our goal this year that we always talked about was to get to 300, and now we're in June and we're at 326 commitments.
Excellent. Are you looking to add to your sort of brand portfolio, or are you good with your brands now and it's really just about sort of growing what you own?
No, absolutely not. We're not good with what we own today. We have an appetite to add more M&A, but just being very disciplined on it, whether it comes to paying the right multiple or finding the right partner or a brand that if, with our hands around it or with our assistance, that we can accelerate the growth, because we typically look to double the EBITDA on any brand that we bring in within the first 2 years. And, so far we've achieved that across our brands. But that is, so if it checks all the boxes, we have, a very sincere interest in getting to minimum 10 brands in the portfolio. And from a real estate strategy, that'll help us really deliver the organic growth and the acceleration that we need to see in our unit count, to increase our free cash flow. So that's what we're after. But, we're at 7 today, and we have an active pipeline that will more than help us meet our target. Which ones we get across the finish line or which ones we get done, time will tell. But do we have the ability to do that? Yes. Do we have the capital necessary to do it? Yes, we do. So we just closed on an above market financing, 75 cents. One of the quite large institution in Canada that came in to support us, which was a big step, but we have the ability to execute now and get to that number. If the deals arise in the right terms, right conditions, we could get to 10, we could exceed 10. But it's just, for me, it's more of a matter of when, not if.
So where's Happy Belly Food Group sort of focused in terms of its expansion from a geographical point of view? Are you still primarily looking to grow in Canada? You mentioned Florida as an expansion market for the U.S. Are there any other regions that you're sort of looking at? And then where in Canada are you seeing the opportunity? Is it really sort of out east?
You know what? Interesting. About 90% of our unit count so far in the development pipeline has been Alberta, Ontario, BC. We recently announced 2 deals that would take us outside of that. One was the LOI for Florida, and the other one was a recent 26-store deal for Yolks in Quebec. That is our 2 new market entries, one being Florida and one being Quebec. We would like to accelerate our brands in those markets as well, now that we have initiated the first footprint. Via area developer in Quebec, we'd like to add more. We're active on opportunities in Atlantic Canada. Actually have guys flying in this weekend, coming in to do the belly check from the East Coast. So I'm happy to host them this weekend and see where things go. For us, it's about people, product, and process. So if we get together with it, they were sent via referral, but if we get together and we like each other, then maybe we'll accelerate our plans in Atlantic Canada. For now, 4 provinces: Alberta, BC, Ontario, and Quebec are on the map, and we're probably halfway down the road of finalizing or formalizing our entry into Florida.
So as I mentioned, you got 3 pages full of like news releases that I was sort of going through. At one point, you guys were putting out news seemingly like every other day. At one point there, I often sort of am begging companies to put out 4 news releases a month. You guys were doing them like 4 in a week, so good on you. That's good. What were some of the more significant milestones and announcements that have been made over the last 3 months since we last spoke?
Well, I think a couple things that, for me, I look for a few things. One is, the deals, right, on the major of the brands. So we've assembled the brands. Usually once we bring them in, it takes us 3 to 6 months to, prepare them for growth. And in parallel, we're actively, mapping out the real estate and stuff like that. So now you see us have the 7 brands in. We've done the area development deals for them. And now you're starting to see us announce the signings of the real estate, which is sort of the next step in the plan, which I believe is pretty material, because then there's actual unit count coming. And now you're starting to see the openings. We just opened Chilliwack. We opened the Well in Toronto with Rosie's. We have an imminent opening in Sherwood Park. We got another one coming at University of Alberta. We've got stores under construction in West Abbotsford. We've got stores under construction in Kitsilano. We've got stores under construction in Ottawa, Scarborough, more coming. So I think, the biggest announcements that have been in the past have been the deals and the closings. Now it's real estate. And then Q2, as we move into Q3, Q4, I think the next biggest news will be openings, because the openings are, again, asset light. They're going to significantly increase cash flow to the company. And obviously then I'd say the last one, I don't know, if every, microcap can typically do this, but, we've announced a financing at 20 cents was above market. We announced one at 30 was above market. We brought in, one of the more prominent people, in my opinion, in the country on our 50-cent round. And now we just brought in K2, a fund out of Toronto. I have to check, I believe, the 13 billion. A very supportive investor that funded us at 75 cents. Very strategic. They have a very sincere interest in the food space from their leadership. I believe, just like everyone else, I believe they see an opportunity in the marketplace for somebody to create a new version of M2I in the market, and I believe that's why we're getting the market support. So, we now have well over $3 million in the bank. We're we're on a clear path to cash flow positive. So I think bringing in that extra acceleration capital is what I'll call it from K2 was a big, step that obviously just closed yesterday, actually. So yeah, I think there's been a lot, to your point, a lot of news, but the openings and continued execution on our financials. Q2 was our 8th record quarter. I think that was a great thing that was announced in, recently. Yes. In May, 8th record quarter in a row. Burn was, I think actual cash burn, from operations was down to like $93,000. That's pretty minimal. One person said to me the other day, well, that's basically cash flow positive. I'm like, well, no. We got to get there. Open more stores, stay disciplined, bring in more M&A as soon as we can, and accelerate our growth of our current brands.
Yeah, so you mentioned financials. So just pulling up sort of Q1. Q1 was 1.88 million in total total revenues. Yeah, that represented about an 80% increase, sort of year over year, same quarter. Q1 23, or just over $1 million, and then Q1 24, just under 1.9 million. So good job there. Would you like to sort of unpack that a little further in terms of what led to the sort of nearly 80% sort of year over year sort of improvement for Q1?
And I think, a big part of that is if you look at the business today, we've had a very material shift. I think when you and I first met and chatted, we were probably 80% of our revenue was CPG derived. And as I think from some personal experience, it's tough to grow and it's tough to be profitable in those two categories. We're very fortunate that our brands are growing and are profitable, but they were about 80% of our revenue previously. As of last quarter, they were 20% of our revenue. 80% of our revenue today is restaurant and franchise driven. So that's where the real growth has come from. And I expect that number to become even more significant in Q2, Q3, Q4. I think even though our brands are growing in CPG, they can't possibly outpace the growth of the QSR side. Just if we were to open our minimum goal this year of 15 restaurants, the royalties on those 15 are very close to fully just eclipsing our entire revenue on the CPG side. So, and obviously the margins, when you can run royalty margin of, let's say, 50 to 85%, that's better than most margins on CPG.
So I was going to ask now, I guess based upon your last sort of announced your Q1, what sort of percentage of your quarterly revenue is now QSR versus CPG?
Yeah, exactly. So QSR revenue is about 80%, and 20% down. CPG is down to 20, which is a complete flip from 2 years ago. It was 20% QSR, restaurant side. So that's changing, and I expect that to accelerate with much higher revenue dollars coming in on the QSR side back half of 2024, including Q2. Q2, what should investors expect? More execution. Hopefully I can keep it boring and we could just execute, and become predictable. Sometimes you get to a certain age in life, maybe, predictable is good. Not as predictable when you're a teenager, and, when you're you're dating, but sometimes predictable when you get a little older, it's, it is better. And that's what we are trying to be. We're trying to become predictable and trusted. And, you can trust that we're busting our ass off and trying to, stay really disciplined on the P&L and not, blowing up our cap table and issuing free warrants and free RSUs and stuff like they're candy, like a lot of other companies do. Their stock's in the toilet, and then they go and issue everybody a reward for bad behavior. Well, the way our deal is structured, nobody gets rewarded here for bad behavior. We have a lot of respect for our shareholders, and we're doing our best to drive value, become cash flow positive. I think last time I checked, we had $230,000 roughly of total secured debt on the company. If you're a company of our size and that's your total secured debt, I think that's pretty good. I think in the current environment, when you're growing CapEx light going forward, I like our chances. I really do, and that's what people should expect the rest of us in 24.
Just in terms of that good behavior, isn't your QSR division now EBITDA positive?
It is. Both of our divisions, actually CPG and QSR, are both EBITDA positive and profitable businesses. I think, we're down to, like I said, total debt of about $230K.
Great. What does a new franchise sort of, your, I guess, average franchise? I know they all differ because there's different size of restaurant, different revenue expectations or system sales. But
yeah,
how are you guys sort of modeling a new sort of like franchise to open? What would that sort of contribute to in terms of annual revenue?
What we look for on the royalty side is, say your royalties and rebates and everything combined is 5 to 7%. So if we were to achieve $50,000 to $75,000 of annualized, call it high margin sort of royalty or SaaS revenue off of every opening, that's what we're looking for is $50,000 to $75,000 a store on an annualized basis that comes into corporate, not including franchise fees or construction or any other business where we have revenue centers, but just strictly off of the residual revenue, we're looking to grow it on an annualized basis by about $50,000 to $75,000 per store. That's why the great leading indicator is our system sales. So, because that's where our revenue is derived from. And if you look last quarter, I think our system sales went from 1.9 million to 5.5 million in restaurant sales. And that's where we derive our revenue from. So the goal is to continue to drive that restaurant revenue. And that's where, we earn our percentage off of in a royalty basis. So, if you could open up, another 100, as an example, you open up 100 restaurants and you're doing 100 million in system sales, then your baseline revenue on the company is going to be 5 to 7 million just in royalties and rebates.
Excellent. Thank you for breaking that down. That's a great answer there. What are some other sort of short-term catalysts that investors can sort of look for over the next sort of 6 months?
Organic growth. We want to see our existing brand portfolio experiencing same-store sales increases. You're not going to see us come out here, and even though Q2 has been softer for weather, I'm not looking to, drop a quarter and say, oh, bad weather. You know what I mean? Like, there's no excuse. Your emerging brands, your growth. You can't be called a growth or emerging company if all of a sudden, Q2 is down and, we're blaming bad weather. I understand if it's, COVID happens or something. That's a little different, but we're expecting accelerated growth. And if we have 14 restaurants under construction at different stages, I'm looking to increase that number. Because 14 plus 3, that's 17. That's 3 that have already opened. Our goal was 15 to 25. We've got some work to do. We still got to find another 8 stores to get them ideally signed and open, or in construction between end of July 1st here and the end of the year. That's what we're actively looking to do. And ideally is going to do some more M&A. We brought in we took in the capital today from K2. Very transparently to accelerate growth, whether it's organic, opening up more corporate stores, which will drive our revenue significantly, or acquire something. And if somebody wants to do a fair deal and come in with us, we'll do a deal on M&A. If not, we'll reallocate the capital into accelerating our own brands. Our own brands are profitable and growing. So if somebody thinks we're going to be idiots just to make a headline and go buy something that's a drag or a P&L or overpay or overexpose ourselves, we won't do it. There's other guys out there that are doing those deals because they don't have the ability to grow organically. There's lots of companies out there that, are closing more restaurants than they're opening. We're not doing that. We're opening stores and we're opening them profitably. So we will happily allocate every dollar towards organic if we can't find an accretive deal that is meaningful to our P&L.
Any projects or developments that you're particularly excited about?
Yeah, I'm. A couple of these are big firsts, right? I think opening Yolks in Ottawa. I think the first ones out of province is huge. We've got a significant audience of potential franchisees that are very let's see what you do when you come to Ontario sort of thing. Rosie's has been experiencing ridiculous performance in the well, and so their recent store openings in Ontario. So now that we've announced our first signing in Alberta, a couple things. We're looking to open that very successfully, and I'm looking to imminently accelerate the growth of Rosie's in Alberta. So I've been spending time there, as you commented on traveling quite a bit, and I was in Edmonton, I was in Calgary, I was in BC, I was in Quebec. I'm not there to check the weather. You know what I mean? I'm there to actively do deals and deliver on our commitments to our shareholders. So, we only have until summer of 26 to get this to $2, and you can bet your ass we're trying everything we can to get there.
Hey, that sounds great. Any final thoughts that you want to sort of leave us with? Anything that we missed?
No, I think, look, hopefully, we're slowly earning some trust and respect out there. Our name's becoming what I mentioned earlier, which was a predictable and trusted player in the market, whether that's potential partners for M&A, whether that's investors, whether that's employees, and landlords. And that's the number one thing that I think is separating us in growth. I was just at an event the other day. Here, guys, multiple CFA event, multiple franchisors all complaining about, we just need real estate. We just need real estate. We just need real estate. One thing we have, real estate. And we're growing. We're accessing the real estate. You have landlords that want our brands, so our brands are in demand, and that's the key to delivering organic growth. There's a reason why a lot of guys only buy, is because they can't deliver the organic growth fast enough to appease the market. We hope to continue to run in parallel, continue our brand count from 7. And significantly accelerate our growth. And once we deliver on our 2024 goals of 15 to 25 open, then I'd like to, at future, be sharing with you what our 2025 goals are. And I can assure you it's not for us to shrink in 2025.
Hey, excellent. Well, Sean, I really appreciate you spending some time with us. It's great to catch up with you as always, and continued success with the business. So thank you
very much, Kieran. I appreciate your time.